we see a lot of blank spots in coverage, and especially in the US, they refrain from doing geopolitical analysis because it would lead them to uncomfortable conclusions. So they stick basically to the economics discipline and to the capital market discipline.
Welcome back, ladies and gentlemen, to the FT studio for our latest episode of the PWM Tea Break with me, Yuri Bender. Today, we'll examine how the fast-developing geopolitical balance between global superpowers impacts some of the hard investment decisions which family offices are taking on the front line. I'm delighted to be joined once more by Beat Wittmann, founder of Porta Advisors in Zurich. And which kind of tea are you drinking today, Beat?
I'm drinking plain black tea, but I have to admit, given the geopolitical circumstances, I would kind of prefer a bit of rum into the tea, like on a ski slope.
Many in Davos probably feel the same thing with President Trump flying in, and I'm sure the Greenlanders are feeling the need for something stronger. The desire from President Trump to take over a neighboring sovereign state. Does this mean the end of NATO?
Thinking back to J.D. Vance at the Munich Security Conference of last year's February, he was very outspoken about the Europeans and also meeting the far-right leader of Germany and not meeting the chancellor. It's not the end of NATO, I think, but Europe has very clearly to be able to defend itself without NATO, because on the eastern flank of NATO, nobody believes that the Americans would honor Article 5. That's perhaps not so broadly communicated, but that's simply a brutal reality.
You are a strong advocate, Beat, of incorporating all of these geopolitical factors into investment analysis and portfolio management. And you wrote an opinion piece for us about this. There's a rival school. Some private banks and asset managers are saying, we only look at market fundamentals. We ignore this geopolitics. It's noise for us. Do you think the markets now are showing that they are taking a huge risk and maybe making a big mistake by ignoring the geopolitics in their analysis?
When you do capital allocation, asset allocation, you have to basically have an interdisciplinary approach between geopolitics, then global economics and capital markets. And there's lots of interdependencies. And then there are financial assets like the currencies, obviously the dollar, or also gold. We see they are truly global assets, and they are very sensitive to geopolitical shifts. And I think a lot of investors still struggle to deal with this because the financial industry is basically operating in silos, asset classes, politics, economics, and all that. And the art today is to have a proper analysis and take the conclusions out of the combined elements.
I spoke to a number of asset managers and private banks recently about their geopolitical views, and most were very negative about Donald Trump, but only the Europeans were prepared to go on the record. All the US managers were saying he's causing absolute chaos, but we can't say anything because 10% of our market value could be eradicated overnight by some legal or economic sanctions. Do you feel that this will change, that there is an anti-Trump coalition forming in Europe and some parts of the US, that these players are realizing that flattery is not the best policy in this case?
There's an amazing amount of self-censorship on Wall Street. So if I read through, for example, the investment outlooks for 26 of the major multinational financial institutions, you have the typical 10 points. 3 are always true, 3 are never true, and 3 are somehow in the middle, so it serves all the purposes. But we see a lot of blank spots in coverage, and especially in the US, they refrain from doing geopolitical analysis because it would lead them to uncomfortable conclusions. So they stick basically to the economics discipline and to the capital market discipline. But then attacking the Fed, I mean, it eats into that financial system as well, because Fed independence is pretty important.
We had a piece from two analysts at Edmund de Rothschild, and they're talking about the interference in Venezuela and how this is a warning shot from the Trump administration to other nations to follow the US line and to go along with the revival of the Monroe Doctrine, where each superpower has its own hemisphere and sphere of influence, and Trump is actually calling this the Monroe Doctrine. In your analysis, do you see the spheres of influence now as the new reality? What does this doctrine mean for portfolio managers such as yourselves in your regional allocations?
We are back to hard power politics, and we are back to a fragmentation into the Americas bloc, into the European bloc, and into the Asian bloc. And the multilateral institutions, be it global trade, be it UN, be it all the other institutions, are on a backseat, and they will stay there for a long time to come. The conclusion for asset allocation is very clearly, it's deep fragmentation in these regions. So our advice the last 1-2 years already has been that European investors really focus on European investments and stick to their reference currency. And if they go outside of that, then it's like a satellite exposure where they have to know and be aware of the risks. European financial assets have vastly better performed than US assets, especially in euro. The news flow, the noise flow has been dominated by US exceptionalism, by the Magnificent Seven, and by the AI investments. But these were not the best performing assets. Many European markets, especially the European defense sector, but also markets like South Korea, they produced performances of 50%. And that has not been noticed really.
The gold and silver are doing particularly well. They're no longer something that private banks and wealth managers just tolerate. They really actively advocate strong allocations to gold. Is this something you've also been doing in your portfolios?
Well, we have been recommending gold exposures for years already, and we stick to that call. Also, of course, the advances have been pretty impressive last year, but it's clearly a reflection of the geopolitics going on, and by the erosion of the dollar, which is de facto also the result of the weaponization of the dollar. And then let's not forget, the US is very exposed financially. The US deficits are financed by the Europeans, by the Japanese, and by the Chinese. So if they don't buy treasuries, there's a huge problem. And one language is very well understood by President Trump, and that is the US bond market.
I was in Kiev recently where I was meeting some drone manufacturers, other people involved in dual-use technology. You were in Warsaw recently as well. We both talked to people who are launching funds in this sector. You've called, in your opinion piece, Ukraine a military laboratory where lots of defense technologies are being tested out, and many people are watching, the Chinese watching particularly keenly. Are there enough opportunities in this area with these new funds for family offices to invest?
The key partners, the coalition of the willing, they have really decided politically to invest significantly in the context of the 5% of NATO goals, and the Germans do it by 29, which goes 3.5% in hard military investment, and then in critical infrastructures. So it's a very vast investment universe. It's not just ammunition or core military stuff. It's really critical infrastructure, energy, transportation. Then it has to do with space, with cyber, command and control infrastructure, newer battlefield technology like drones. And that's a very wide universe, geographically speaking in Europe, then by subsectors, and then also by life stage of the companies. A lot of venture capital investments, then neoprime companies, and then of course the traditional big contractors like BA, Rheinmetall, Leonardo, Thales, just to name a few. So there's a lot of money flowing into these ones, and I expect a whole range of funds being launched this year, mainly focused, of course, in private markets, because the public markets have already impressively performed.
In your home country, Switzerland, some of the larger banks have suffered, and we're seeing the rise of the boutiques. You're running one of these, and my colleague Elisa wrote about the Swiss Private Banking Identity Index in an article that was just published. And it's interesting to see which banks are performing well in that. Pictet doing incredibly well with their branding, and some of the smaller players, Piguet Galland and Banque Heritage, scoring very well, and some of the larger ones not really able to explicitly communicate their values, their beliefs about the world. Are you surprised to hear this? Which firms are doing well?
I'm not really surprised. I mean, Switzerland in this type of epochal changes in geopolitics is a safe haven place as a custodian in wealth management, in asset management. So I think Switzerland is very well positioned for that. The other part is the banking landscape is basically the big banks and then the specialized ones, privately held. The multinational banks have, of course, always difficulties a bit politically, as we spoke before, about what is geopolitics, what is economics, what is investments, and then they are just very large. They have to treat clients in a similar fashion. It limits their room to maneuver for very specialized views, simply. And then the owner-run banks like Heritage or Pictet you mentioned, they're very well run, their interests are aligned really, and they're very focused, and they can have an opinion really on things. And that matters an awful lot, to have an informed, independent opinion on geopolitical developments, on capital markets developments, and then position your portfolios like that, and then hopefully reap the benefits of that. And it gives you also credibility down the road.
Well, the informed opinion, Beat, is one reason we will always keep asking you back into our studio. We know you're off to Munich soon to participate in the security conference there, where we had those dramatic events last year, and we look forward to your feedback from that conference. But thank you very much for joining us today, Beat.
Thank you, Yuri. Pleasure.
You know, our FT kettle is always on the boil, and we extend a warm welcome over a cuppa to commentators prepared to discuss the key issues. So please join me next week for a deep dive into the tea leaves to look at some key challenges for the future of wealth management.